Ratio and variance analysis. We are going to discuss ratio analysis overview, profitability ratios, liquidity ratios, solvency ratios, performance metrics, limitation of ratios, and finally, variance analysis, actual versus budget. Financial ratios that we're going to discuss, they are numbers that would help us explain how well our business is doing by comparing different parts of its financial statement. Like we would do profitability ratios, we use assets, debts, sales. So all these ratios that we are going to calculate today, they simplify financial information into percentages, into numbers that are easy to compare with previous years, easy to compare with the competitors or industry average. So we are going to discuss this extensive balance sheet given for 2 years and the income statement, and we use these numbers to calculate various ratios to understand the dynamics and understand how we gauge performance, how do we gauge profitability, liquidity, solvency, and so on. These are the 4 sets of ratios we will discuss: profitability, liquidity, solvency, and some other performance metrics. So let's first discuss the profitability ratios. First one is gross profit margin, or just GP margin sometimes. It is calculated by taking the net sales, that is sales less returns, minus CGS, that will give you the gross profit. Gross profit expressed as a percentage of net sales. And let me show you how do we extract these numbers from income statement. So here we have sales less cost of sales. So this is gross profit. Gross profit expressed as a percentage of sales. So $800,000 upon $1.8 million multiplied by 100, that gives you gross profit percentage. That's your performance as far as gross profit is concerned. That gross profit is what percentage of sales? It's 44%. Means if sale is considered 100, gross profit is 44.44, or if a company makes a sales of $100, $44.44 represents gross profit. Next we have profit margin. Profit margin is net income for the year divided by net sales. Simply plug in the numbers and calculate the result in percentages. So this is the figure for net income. Net income after tax is $200,000. It is what percentage of sale for you to, you can also calculate for the last year, and then you can make the comparison between two, that how have we done, has net profit percentage increased or decreased. We could say the same with GP. Gross profit was what percentage of sales last year, and it is what percentage of sales current year, and you can make the comparison between these year 1 and year 2. So taking this $200,000 and expressing it as a percentage of 1.8 million gives us, let's see, okay, it's 11.11% for the current year, year 2. We don't know whether it's good or bad unless we have some competitor, maybe from year 1, maybe from industry average, or maybe some leading competitor. Okay, so then we have return on sales, that is income before interest income, interest expense, and taxes divided by sales net. This is our net income before income taxes, so we need to add this interest expense back. So you will have 303,030 plus 10,000 and divide it with the sales, net sales figure 1.8 million, and the percentage that you will get would be 17.39. This is your return on sales. So your return on sales is 17.39%. Is it good or bad? We don't know unless we compare it with last year, with the competitors' return on sales, or the overall industry returns on sale. Next measure of profitability we have is return on assets, that is net income expressed as a percentage of average total assets. Now there is a key point to learn, that net income is for the whole period, quarter, 6 months, or for the whole year. So you can't take assets on the specific point in time. It is recommended that whenever a net income item is combined with the balance sheet item must be average. If it's net income for the whole year, average total assets must be from the beginning and ending balance divided by 2. If let's say your net income is for the quarter, then your opening assets at the start of quarter, assets at the end of the quarter divided by 2. So that's why, is to make them more comparable. So net income over average total assets will give you return on assets, how well you have generated income using the assets available. So let's see the numbers. So this is your net income, $200,000 for year 2, and this is the figure for your total assets at the end of the year plus total assets at the start of the year. So if you take the average figure would be 2.782,500. This is the denominator, average assets, and in the numerator we have net income, which is $200,000. If you simplify, the result would be 7.2% for the year 2. So again, we can't say it's good or bad. You need a comparator, last year, competitor, or the industry average. Another important ratio that we use is DuPont return on assets, which is basically the multiplication of profit margin and assets turnover. In other words, your return on assets can be decomposed into profit margin and assets turnover. We know profit margin is net income over net sales, and the assets turnover is sales over average total assets. So basically, if you just simplify, you get the same thing. Sales cancelled out. Net income over average total asset. That's exactly what we have just discussed. So why do we need to break this down? We just like to see that return on assets can be explained by these two constituent percentages, right? And that helps us, which if return on asset, if it has increased or decreased, what is it is because of profit margin or asset turnover. There's an extended breakdown of return on asset that we study on CFA, but that's, I think, the extent. You don't need to go beyond that. So let's plug in the numbers, see what do we get. So this is the figure for our profit margin, which we already calculated. Next, we need sales over average total assets. Sales we already have. We have the figure for sales. We need average total assets figure. This is the average total assets, 2.782 million. So let's just calculate it there. Sales over average total assets. If you simplify, 11% times 0.646. So return on assets 7.22, which is same as what we calculated previously, but now we have its decomposed form, and then we can analyze the result in more detail. Next profitability ratio we have is return on equity, that is net income over average total equity. So again, net income from balance sheet, income statement, and equity on the balance sheet must be averaged. Let's do it. So we are doing it all for year 2. So this is our net income figure, and the equity figure, average total equity. So this is it. Equity figure for the start, 1.35 million plus 1.47 million divided by 2. So if you do that, we have our net income, $200,000, dividing it with the average of these two, that's 1.47 million plus 1.35 million divided by 2. The net answer is 14.18%. So your return on equity is 14.18%. Is it good or bad? Again, we need to see last year's numbers, compare it with the competitor or the industry average. Next, we have operating cash flow ratio. That is again one of the profitability measures, that your 275 is your operating cash flow from operations, and your current liability 695. So your operating cash flow is 275, your current liability is 695. That means the result is 0.396. That means for every $1 liability, business has generated cash from operations 0.396. Again, is it good or bad? We can't say unless we have some comparator. Next set of ratios we have is for the purpose of measuring business liquidity. What is liquidity? Liquidity is the business ability to pay its current obligations when they become due. Means you have some maturing obligations for bank overdraft, accounts payable, other dues, right? So how comfortably a business can pay current liabilities, it is measured through these liquidity ratios. So first of all, we have the ratio called the current ratio, in which we take current assets in the numerator and current liabilities in the denominator, and then this fraction will reveal us some important information. Let us calculate current ratio for both current and the last year. So this is the figure for current liabilities last year and the current assets last year. 765 is the current assets, 700,000 is the current liability. The figure, this divided by this, gives us 1.03. And similarly, current assets for year 2, 715, and the current liability 695, this divided by this gives you 1.09. So what it means, Last year, for every $1 worth of current assets was available for every $1 of liability. So means for every $1 liability, we had $1.03 worth of current assets. And this year, we have slightly higher. So this was the figure last year. We have had slight improvement, but we're still way behind the industry average. So it means our liquidity position as calculated through current ratio isn't good. A little refinement in measuring liquidity. Previously, we took all our current assets and divided it with current liability. But the point here is that your current assets include two specific items which are not readily convertible to cash, like your inventory and your prepayments. So if you exclude your inventory and prepayment, that will tell us that only these items remain: cash and cash equivalents, short-term marketable securities, and net receivables, that is gross receivables, less allowance for uncollectible accounts. So if you take these numbers, three numbers, or simply take all current assets and deduct your inventory and your prepayments, you get the same numerator and divide it with the current liabilities. So let us do it for both years, year 1 and 2, and then make some conclusion. So these are our quick assets: 35, 65, and 390. You do not take inventory, and also you do not take prepayment. So dividing the sum of this with the current liability, what you get is 0.7. It tells us for every $1 liability, we have 0.7 worth or $0.7 worth of quick assets, right? What is the situation in the current year? This is the figure for quick assets: 50, 75, and 300, and dividing it with the current liability for year 2, 695. The result that you get is not encouraging. It's 0.61. That means our liquidity has further deteriorated. Remember, this quick ratio is more conservative because it ignores or it doesn't consider inventory and prepayment. So you get to take those assets which are more or less readily convertible to cash. So that tells us that our liquidity position has deteriorated on some conservative measure like quick ratio. Quick ratio is also called the acid test ratio. So clearly our ratio has deteriorated over the year, and it is still far behind the industry average. So it means our liquidity as calculated under the quick ratio and the current ratio, they are both not encouraging. Next, we have account receivable turnover. It shows you how quickly or with what speed your customers pay you in 1 year. So you take your net sales over average account receivable. The result will give you an indication that how quick your assets account receivable convert into cash. If they convert into cash quickly, that means your liquidity would be better. So let us calculate our account receivable turnover for year 2. Sales 1.8 million upon average receivables, that would be available here on the balance sheet. Our receivables last year were 390 and current year it is 300. So adding these and dividing by 2, so that gives you 345. So your sales, ideally we would like to have credit sales, but if it isn't available, you may take the figure for sales. So what we get, 1.8 million upon 345, that means our customers pay us on average 5.22 times in a year. Customers pay on average 5 times, nearly 5 times in 1 year. That could be sometimes a little bit confusing. We can also find another measure which is called day sales in account receivable, which is more understandable. Let's do that. So that's what we just found out. And this is a more meaningful way to understand how do we deal with our customers or account receivables. So just look at what we have done. We took sales on average account receivable. Here it is opposite. Average account receivables upon sales multiplied by this. Actually 365 is right here. So if we just simplify this, it gives you 60.83. So there are two ways of saying it. Either you say that my account receivables turn 5.22 times in a year, or you may say that my customer on average pay me after 60.83 days. That is approximately 61 days. So that is also called your average collection period. Or there is one more way that we can put it this way. Days sales in account receivables. It means for nearly 61 days, our sales remain in the form of account receivable. After 61 days nearly, we get the cash. So you may say it's average collection period, average time taken by our customers to pay us, and this is the number of times our customers pay us in 1 year. Next, how quickly we are able to convert our inventory into cash or into account receivable, and of course account receivable into cash. So it's calculated taking cost of goods sold over average inventory. This is the cost of goods sold for year 2, and these two numbers are for average inventory figure, opening and closing over 2. So basically this is the CGS upon average inventory, 3.54 times. It means our inventory is sold nearly 3.5 times in a year, or you may say that our inventory is refilled or replenished about 3.5 times in a year. Appropriate way to calculate this is in number of days. So you do the same thing which you did previously. Take inventory average figure in the numerator, CGS in the denominator, multiplied with 365. That's it, right? Average inventory in the numerator, CGS in the denominator. He has taken ending, you may take average. Average is more appropriate. So average inventory over CGS times 365. This tells us that our inventory on average is sold within 1 or 5 days, right? So what we have, our customers pay us on average in 61 days. Our inventory is sold nearly after 1 or 5 days. Now there is third component. If you add these two, this plus this, it gives you the operating cycle. So operating cycle is equal to your average collection period plus your inventory turnover days. If you add these two, you get your operating, the length of your operating cycle. Ideally, we would like to have it as short as possible. Now let us add another component to it, which is the accounts payable turnover. As the formula tells you, it's CGS over average accounts payable. It tells us that how frequently we pay to our supplier. We pay our supplier nearly 7 times in a year. We would like to know after how many days. So we do the same thing. Ending accounts payable, ideally you should take average accounts payable over CGS times 365. So that gives, we pay our supplier on average 54.75 days. So that's the average payment period. Now, if you bring this into the picture in operating cycle, we just learned that operating cycle, the length of operating cycle is account receivable turnover, which you call the average collection period, plus inventory turnover in days. And if you take these two and deduct your days of payables outstanding or average payment period, you get cash cycle. That's it. So your cash conversion cycle is your day sales in account receivable, which is also called average collection period, inventory turnover in days, and from this you deduct days of payable outstanding or average payment period. This gives you the cash conversion cycle. Ideally, we would like to have it as little as possible. So for this, your day sales should be as low as possible, days in inventory as low as possible, and your days of payables outstanding should be as large as possible, so as to have as little number as possible for our cash conversion cycle. Now we have our third set of ratios, solvency ratios. First of all, what is solvency? If liquidity is your ability to pay your current obligation as they become due, solvency is the business ability to pay its long-term obligation when they fall due. So liquidity measures your ability to pay your current obligations, and solvency measures your ability to pay your long-term obligations like long-term bonds, notes, long-term debts. So there are some formulas. First is debt to equity. You take total debt in the numerator and total equity in the denominator, and you do it for both year. That's what you get. So let us try to interpret what it means. Last year, for every $1 invested by the shareholders, the business had a total liability of 1.04, which means the debt was more than equity last year. And in this case, in current year, for every $1 of equity holders, debt is 0.91. So that means our solvency has improved. Our debt proportionally is lower proportion of equity. Previously it was higher. So yes, debt to equity ratio, the measure of solvency, shows that our solvency has improved. Debt as a fraction of the equity has decreased. Next, total debt ratio. It takes total liabilities, that is current and non-current, divided by total assets, right? So last year, our total liabilities were 1.4 million, total assets were 2.75. Now it showed us that the debt ratio was 50.91, which means for every $100 asset, debt was 50% of the assets, or nearly 51%. And in the current year, if we invested $100 on our assets, debt represented 47%. So previously it was 50% or 51%, now it's about 47%. That means debt is now a lower proportion for total assets, so our solvency has improved. Next, we have a very important measure, equity multiplier. Equity multiplier basically shows how much of a company assets are funded by its shareholders' equity. It helps us to understand how much debt or leverage a company is using to finance its assets. So we take total assets and divide it with the total equity. So last year, it was 2.04. What does this tell us? It shows that for every $1 of equity, the company had 2.4 or 2.04 in total assets. The larger the multiplier in year 1 suggests that the company used more debt compared to year 2. But look at it year 2. It's 1.91. This means for every $1 of equity, the company has 1.91 in total assets. The difference between the assets and equity, as you can see, 2.815 less 1.47. It is funded through debt. So you may say that we are now less leveraged, or in other words, debt is now a comparatively smaller part of equity. That's exactly what the whole previous ratios are indicating, that debt is proportionally less. Next ratio we have is times interest earned. Next we have times interest earned. It is also called the interest coverage ratio. It is calculated using income before interest expense and taxes over interest expense, or earning before interest and taxes upon interest expense. So what basically is measured? This ratio shows how many times a company can cover its interest expense with the earning that it has generated. So what do we have is this is the earning before taxes. So we add back the interest expense. So that would become earning before interest and tax. We divide it to 10,000. That means out of the available earnings before interest and tax, we have to pay just 10,000 interest, which is like we have 31.3 times of the interest expense as our earning. It means simply we can pay interest of $10,000 31 times out of the available earnings. We have to pay only once, but this is only showing you the level of comfort with which you can pay your interest. So a higher times interest earned shows the company is easily able to cover its interest expense. Here, we're in a very strong position to pay our interest obligations. Next, we have earning before interest, tax, depreciation, and amortization. Now, this is a very interesting financial metric. This is used to measure a company's operating performance. It especially focuses on how much money a company makes from its operation before considering the cost of interest, taxes, depreciation, and amortization. So there are two ways we can calculate EBITDA. One is the top-down approach, other is the bottom-up. Let me take you back to the income statement. I explain it from there. In top-down approach, you start from sales, deduct cost of goods sold, deduct operating expenses, and that's all. Just these three, right? Take your sales, deduct CGS, deduct operating expenses, you get your EBITDA, earning before interest, tax, depreciation, and amortization. That's it. Take sales, cost of goods sold, and operating expenses, excluding depreciation. So that's how you calculate for both years. Then we have the bottom up. You do it the opposite order. Let me show you how. Now you move in the opposite direction. You start from net income. That's your starting point. You start from your net income. You add back taxes. You add back interest. And if there is any depreciation, you add back. So basically it is net income plus interest plus taxes plus depreciation and amortization, and you reach the same number. Net income, taxes, interest expense, depreciation and amortization, and this would give you exactly the same result, whether you use the top down or bottom up for year 2, top down or bottom up for year 1. Next, we have earning per share. It is calculated using this ratio. EPS is equal to income available to common shareholders divided by weighted average number of shares. We'll discuss this topic in detail in the coming lectures. So your income available to shareholders is $200,000 and weighted average number of shares. That's what basically it is measuring. It shows how much profit a company makes for each share of stock. It makes $2 per share. Next ratio we have is the price to earning ratio. It takes market price of the share, divided it with the basic earning per share, right? So like consider the market price is $12, EPS we just calculated 2. So what it shows us that the market price for a $1, let's say a share that has a $1 earning, investors are willing to pay $6. So why would you pay $6 for a company that is just generating $1 of earning? That shows in profit potential of the company. So this PE ratio, it compares price with the earnings. It shows how much investors are willing to pay for $1 of earning. In this case, for every $1 earning, an investor is willing to pay $6. So higher this ratio, that means investors are willing to pay more price for this company. This company expects to grow in the future. Then we have next one, dividend payout ratio. Cash dividend over net income. So let's say this is taken from the original example, $0.8 dividend per share. There are 100,000 shares. So that means $80,000 dividend has been given, whereas earning was $200,000. So that means $80,000 has been given as dividends, whereas earning was $200,000. That means 40% of what the company earned has been given as dividend. That's what you call the dividend payout ratio. Those companies that do not have profitable projects on hand, they would tend to distribute most of their earnings to the shareholders, but those companies that plan to reinvest their profit into profitable projects, for such companies, dividend payout ratio is normally low. Next ratio we have is assets turnover. Assets turnover ratio, it measures how efficiently a company uses its assets to generate sales. Sales is in the numerator, total assets are in the denominator. So since sales is from income statement, total assets come from balance sheet, and we discussed and agreed that the balance sheet item should be averaged. So we are going to take our sales for the current year and divide it with the average total assets. What it tells us that for every $1 invested in assets, we were able to generate $0.65 worth of sales. Or in other words, sales are 0.65 times of the assets. The higher the better. It tells us how many dollars of sales are produced for each dollar of asset the company owns. The higher this ratio means that the company is using assets more efficiently. If the ratio is low, that could indicate that the company isn't using its assets effectively and efficiently, or it has too many assets for the level of sales it is generating. These assets are not fully utilized. Next, we have limitations of ratios, the weaknesses in ratios. First weakness is dependence on data reliability. That means ratios are only as accurate as the data they are based on. Means if the data is bad, ratios would be bad. If the data is good, then only your estimates will be good. So that means, moreover, your data may be influenced by estimates. Maybe you're using historical cost or sometimes fair value measurement. So it's all about the data. Ratios are as good as the data fed into it. Next limitation is lack of context. Ratios by themselves, they do not provide sufficient information for comprehensive analysis. We are just using numbers. Those numbers do not speak for themselves. So we have to compare them with industry average, historical trends, our expectations, our last year performance. Next limitation, inability to reflect trends. Yes, ratios may not reveal changes or trends over time without a deeper analysis, which we normally do in horizontal analysis. So if you want to see performance, whether it is improving or whether it is declining, you need just not 2 years data. You need maybe several periods data, which you call horizontal analysis. So just a couple of years or just a single year is not enough. Next, inability to standardize for comparison. Yes, ratios are not standardized. Only earning per share is standardized as per IAS 33. Otherwise, there is no standardization for ratios, and that makes it difficult. Companies may use different accounting methods which can distort ratios. That's the issue. Limited use for cross-company comparison. Yes, ratio can be misleading when comparing companies of different sizes or from different industries. Ratios do not show absolute performance. Yes, ratios only provide you relative measure. They do not provide you absolute financial performance. For example, a ratio may show a company has a strong profit margin, but it doesn't tell you the actual profit. So for complete analysis, ratio should be used along with the actual dollar amounts to provide you the more insight into the data. This is the last subunit of your current section. Okay. Neostar Corporation has prepared its annual business plan for year 1. the organization anticipated that it would sell 10,000 units of its product at 15 apiece. So this is your original budget prepared for 10,000 units. And all these numbers are based upon the budgeted units of sale and production. And it further says that its contribution margin percentage would be 20% and its fixed cost would be 25,000. Actual units sold numbered 8,000, totaling 112,000 in revenues, variable costs 108 this and fixed cost this. So if you're making this comparison, that is misleading. It's because the budget was originally prepared for 10,000 units. You are comparing it with the actual performance of 8,000 units. This is a misleading comparison. All these variances which you have calculated, like this was expected revenue, you got less, unfavorable. Variable cost should be 120, it's less, that's favorable. Profit should have been this much, it's less, unfavorable. Fixed cost should have been 25, it's 24, favorable. Overall, this should have been the overall profit, but we incurred a loss, unfavorable. This is not the right comparison. This is misleading. What we do basically, we take the original budget and we revise it. If the original budget is for 10,000 units and the actual performance is 8,000, we flex this budget and revise the budget as if the budget was for 8,000 units. So for all the 8,000 units, revenue, expenses and all that. And then we compare 8,000 budget with the 8,000 actual. That is a meaningful comparison. That is much more understandable. That's exactly what has been done. So we have taken our budget, original budget, and we flex it for 8,000. So we revise the budget as if 8,000 units were planned and produced. And we compare this budget of 8,000 with the 8,000 actual performance. That's the right comparison. Now just see. So as per 8,000 units flexed budget or flexible budget, our revenue should have been $120,000. Whereas for 8,000 units, it was 112. So this is clearly revenue is 8,000 adverse. Then for 8,000 units, our variable cost should have been 96,000. Whereas for 8,000 units, our variable cost was 100,800. So this clearly shows that it was a adverse variance. So overall, that's the final result. But when comparing the fixed cost, our flexible budget says the fixed cost should have been 25. Actual fixed cost was 24. So overall, we have a favorable fixed cost variance. And finally, we can now compare our flexible budget, says $1,000 loss, whereas our actual results indicate a much wider loss. So that is what you get the figure, and that's how we compare the budgets. You do not compare the actual results with the master budget because it was for 10,000 units, it's for 8. So we revised the original master budget into a new flex budget of 8. So it's 8 budget versus 8 actual, and that's what you call the flexible budget variance, and that is of most importance to us.